So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to The Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to The Daily Call. Today we're going to help you understand the difference between an odd lot versus a round lot with some examples. So I've seen a lot of definitions out there of the differences when orders go through with regard to stocks or futures or options contracts, and the differences between odd and round lot orders. And so there's no one definition of it, but here's generally the concept around these. Round lot orders are orders that are easily disseminated across multiple parties in the market. So order types for stocks would be orders of 100 shares, 200 shares, 250, 500, 1,000 shares. Something that is a generally round number of orders, kind of rounded to a nearest grouping of trades that can easily be exchanged with another party in the market. So if you're trading 100 shares and someone else is trading 100 shares, it's very easy to make those two parties come together and create a filled order. A odd lot might be something like 97 shares. So instead of just rounding up to 100 shares, you buy exactly 97 shares. It's a little bit harder to fill those orders because now the market has to split that order into possible multiple fills across different parties. They might take, 90 shares from one person and 7 shares from another person to complete this order for you, which means that it might take a little bit more time for your order actually to get filled. We see this a lot actually in options trading as well. So typically people end up doing groupings of contracts, sometimes 5, 10, 15, 20, etc. contracts at a time. So I would consider those generally to be round lot orders. If you do an option contract order with, say, 7 contracts or 9 contracts, you might see your order get split among different exchanges, or even within the same exchange, have partial fills with your order. You might get 5 contracts filled initially, and then you have to wait for the other 4 or 3 contracts to get filled later on, maybe at different pricing at a different exchange. So sometimes a little bit harder to fill these odd lots. Now, all of this being said, I don't think this should make a big difference in your trading. I think you should still go with whatever contract size or premium size you need to go with to keep your risk in control. So a lot of times when I make trades, I will base my contracts purely on amount of risk or the percentage of risk that I can take in my account. I won't really factor in these like odd versus round lots in my decision making because I don't really care about filling trades exactly when I make the order. I have the patience that if a trade doesn't fill, I can try it the next day or the next day or the next day, and I can adjust my strike prices as needed. So hopefully it helps out in at least understanding potentially why maybe some of your orders are taking a little bit longer to fill than some others. And as always, if you guys have any questions, let me know. And until next time, happy trading. Thanks for joining us on The Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on The Daily Call from OptionAlpha.com.